Hi, I'm here with the very highly rated Pengana Emerging Companies co-founder and co-portfolio manager, Ed Prendergast. And Ed, really interested to hear your thoughts about what are the stocks in your portfolio that you're really excited about.
Sure. At the moment, there's two or three sectors which we can group together for to chat about. One is tourism, which is a sector that really we hadn't invested in until about 12 or 18 months ago, because most of it relates to domestic tourism, and most people are going to Bali and Fiji in the States because the currency was in their favour. That's changed quite dramatically in the last 18 months, so travelling abroad is very expensive, and equally it's cheaper for people overseas to come to Australia. So there's been a real switch in the demand profile for operations like, our investments confined to things like hotels and ferry operations, which there's always an esoteric angle in small caps, but and so they're seeing increased inbound tourism, not only from America and Europe, but China's got a structural growth element to it as well, and they earn US dollars, so it's cheap to come to Australia now, and capacity in the airline industry from China is increasing pretty dramatically. So that's driving the inbound side of things. Then the internal tourism, as I mentioned before, it's more expensive to go overseas now, so the Australians are sort of staying local. So the hotel industry, our exposure is via a company called Mantra, which is the brand as well, so it's pretty well known. Occupancy in hotels has been rising in the last 2 or 3 years, so has price a bit, particularly Melbourne and Sydney. There's no new hotels coming on board, and this is even when corporate travel is still pretty depressed. So if you get a recovery in corporate travel plus tourism, they'll hit a point where they just raise rates by 10%, and if they do that, the profit growth will be sort of 30 or 40%, because there's no increase in cost at all if they raise their prices. So we certainly like tourism. And as I mentioned before, Sea-Link, the ferry operator, a lot of Chinese tourists going to Kangaroo Island, for example, and North Stradbroke on their operations. The telco industry is another we like, mainly because the industry structure favours the listed mid-tier players, because Telstra's the big gorilla, if you like, and then then they're slowly leaking market share and have been since deregulation in the 90s, I guess it was. The mid-tier players have the advantage of being listed and can buy smaller unlisted players, and when you bolt together two telecommunications resellers, you get an increase in your buying power on the wholesale side. So 1 and 1 is often 3 in that sector, and so companies like M2 and Vocus and TPG have done very well, and Big Air along those lines. And aged care is another one that we have a fair exposure to. It's got, I guess the other thing with telecommunications and aged care, there's no cyclicality in the business. People will always, it's not a discretionary item, either of them. But aged care there's basically a shortage of aged care places in Australia. The government has said we need 70,000 more beds by 2020. There's only 3 listed players. They have a natural advantage in that the government's trying to push a quality outcome. They don't just want everyone building low quality aged care, because it's obviously it could be a disaster. So they're pushing for industry rationalisation. It's very fragmented. The 3 listed players now have the currency to actually acquire small players that are poorly run and fix them up, and there's a financial benefit in that as well. So and equally there's no risk of an economic downturn in that sector.
And particular stocks you like in the aged care sector?
Estia, Regis and Japara. And then retirement villages, we own a little company called Lifestyle Communities, which develops retirement villages, which is just the one age group below aged care, if you like.
Yeah.
It's pretty stable.
And I mean, Estia might be familiar to some of our clients because it floated not long ago, had a shocking debut on the market. Is that common with small caps, for there to be high volatility either around listing or at certain points where you see really big differences between what some people think it's worth and how it trades? Yep,
absolutely. And Estia is a classic case of emotion and irrelevant issues driving a share price in the short term. And it had, so we didn't invest in it at the float because we just wanted to wait and see. It had made some acquisitions. We wanted to have 2 or 3 meetings with them to sort of bed down our thoughts. But what you saw there is Japara listed, then Regis, and by the time Estia came up, everyone said, oh, we got the first 2 and we like the sector, but we don't need a third one. So there was that sort of stand back, and no one actually subscribed for the float, and it wasn't particularly cheap at the time. And also the 2 listed competitors sort of pointed out, as you would, everyone would bag their competitors. They were sort of highlighting that Estia was the sort of third-rate version, and that we don't agree with that, but anyway, that itself meant that there just wasn't any buying when they floated it, and in fact, the day it floated, people were more sellers than buyers.
Yeah.
And that's what happened with Mantra 2 years ago when they
Okay.
floated that. There was we subscribed to the float, and at the time there was some volatility in the share market, and also everyone had sort of had it up to here with IPOs. There were just too many of them, and so there was a bit of a standoff. And we took as many as we possibly could. We really liked the business, and knowing that all this short-term noise will disappear and the asset, it'll be recognised at some other point in time, and it was. So, but SES falls firmly into that case.
And so finally, there's a lot of concern about, a slowing Australian economy and whether Australia is a good place to invest. Are you still seeing good opportunities to put money into for clients, or are you sort of retreating to cash?
No, we're fully invested, and certainly, so the Australian economy is patchy, and as it relates to how we look at investments, each stock's in their own little economy. So the mining stuff we wouldn't touch at all. Retail is pretty patchy. We're pretty wary of discretionary retailers. Housing activity's been quite strong for 2 or 3 years, but the share price is already reflecting that. So we have sold out. Others might hang on. And then financial services, for the same reason we were chatting earlier about the volatility, we still think there's a bit of a tailwind to come from financial services when people finally realise their term deposits are not the answer and shift back into higher risk assets, and that'll boost the fund managers and the platform type businesses. But really, but 2/3 of our portfolio is in companies that don't require any economic growth. They can grow, whether it be in healthcare or telcos or whatever it might be. They've got stable and structural growth drivers. So we don't have to kind of stress about the economy for those sorts of businesses. It's more about, are they going to manage the growth properly?
Okay, that's really reassuring. So thanks so much for your insights.
No worries.